Okay, hi, good afternoon, everyone. Welcome to our Tuesday afternoon webinar series, where we'll be talking about several investment ideas that you can consider in this period of this COVID-19 crisis. So before we begin, I think some housekeeping matters. If you have any questions about what I'm talking about today, maybe we can perhaps wait till the end of our session because it's not going to be too long. And then you can either raise your hand or type in some of the questions on the chat box over here on the Zoom platform. Or after that, you can always speak to your iGM advisors if you already are acquainted with any of us. All right. If not, you can always drop us an email at inquiries@ifastgm.com or give us a call at the number stated here. All right. So without much ado, I'm just going to start sharing my screen. All right. So I believe you can all see my screen right now. Okay, so let's just begin talking about who iGM is first. Okay, so iGM stands for iFAST Global Markets, all right, as you can see over here, and we are the investment advisory arm of iFAST Financial Private Limited, right? iFAST Financial is basically a integrated wealth management platform, and we were founded in 2000 and listed in 2014, just about 6 years ago. Right, we launched iGM with the main objective of trying to help our in-house clients invest globally and profitably, while also protecting them with the complete commission and information transparency in our delivery of services. Right, our advisors are backed with a full support team over here, the investment team, such as myself. And of course, and some of our operational and operational staff who are also quite on the ball. So where we are, we also offer all-in-one platform solutions such as your stocks, your bonds, ETFs, and unit trusts as well, and even an in-house discretionary portfolio management service. So really, all-in-one integrated financial management, financial planning platform where we have all these advisors over here in your arsenal for you to engage with. And if you ever want to engage with us, you can always look for us later on, as you can see in the contact that I shared just now as well. All right, so we offer 24/7 access as well with our iGM app just launched last year, and that allows you to have 24/7 accessibility to your own portfolios or financial markets for that matter. All right, so let's now dive straight into the topics that I meant to talk about today. So we'll be talking about 4 things today. My name is Dylan, by the way. If I haven't already introduced myself, my name is Dylan. I'm part of the investment consultant team over here, and I assist all the financial advisors here on iGM. Okay, so basically I assist them with portfolio construction and anything to do with investment related queries. So such as today, where we'll talk about some of the investable ideas that comprise China, the digital economy, some bonds that you can get yourselves onto, and as well, we'll be talking about Microsoft, which is one of the stunning blue chip tech stock ideas that our team is holding a very strong call on. All right, so first off, let's start with China, right, which is probably also one of the major countries among everyone's minds. So undeniably, we talk about why China will be the global economic leader of the recovery this year. Okay, so undeniably, we see that the COVID-19 crisis has taken a toll on almost everyone, right? China was where it's all started, and in the first quarter, we saw, all the cases coming out from there. And of course, from there, we see a lot of economic readings being published at a near historical low. But we do see, however, that cases have started to stabilize, as you can see in this right-hand side chart over here, as the number of cases in China start to stabilize since the beginning of March due to the countrywide lockdowns. And most of the outside areas outside of China are also starting to stabilize, as we see in most of the news on the headlines, right? But let's just take a look at some of the deeper details over here. So you can see over here that on the economic front, most of the economic indicators have kind of taken a hit in the first quarter of the year, right? So you see that as of end of March, the official PMIs, consumption data, even investments and exports, imports were all in the red, right, for the first quarter of the year. right? And I think the minimum was about a mean 20+%. So I think undeniably we see that the coronavirus has hurt China's economy quite badly in the first quarter, right? But that being said, investment is all to do with what's going to happen in the future, not so much of what's happening in the past, right? So although we understand that, um, the economy has taken a hit in the first quarter, we are actually trying to set our sights on what's going to happen in the second quarter and beyond. So with our team has actually done this kind of analysis. So we actually use macro data releases and our own analysis of how how the current COVID-19 situation will actually pan out, and we approach this in three different kinds of formats. So of course, we have a base case scenario. If you were to turn your attention to the neutral circle in the middle, right? So in the base case scenario, we expect a rebound of economic activities from the second quarter onwards, right? As the economy starts to reopen and recover. So domestically, a lot of the negative impacts associated with the virus has kind of been priced in as meant to be subsiding from the second quarter onwards. And policymakers are actually doing quite a lot, as you can see, all over across the world as well. So we do believe that with the fiscal and monetary policies in place and the kind of cases starting to stabilize, we believe that this convergence is going to help the Chinese economy recover in the second quarter onwards. But I believe what is interesting is how we can actually expand this view and see how things might potentially pan out, right? I mean, the neutral case is just maybe perhaps a base case scenario, but if let's say we were to try to extrapolate to see how things could be better, if there's an optimistic scenario, or it could, if things turn for the worse, how would things pan out in a pessimistic scenario, right? So these are some of the GDP projections that our team has kind of come up with, right? So we see that the base case scenario, we do believe that, for the second, third, and fourth quarters, we expect some recoveries in the GDP growth rates, and that will be projected as of end March about a 3%, 4% kind of GDP growth rate for China as a whole for 2020, right? For the optimistic case, if we see that let's say if the vaccine comes out faster, or if the economy reopens faster than we expected, spending increases as faster than we expect, then we can actually be a bit more optimistic about it. And our team has actually assigned about a 6%, 5.9% GDP growth for the year 2020 for China. But of course, we also are wary of the fact that there is a slight possibility of, let's say, a second wave of infections, and therefore that formed our pessimistic case scenario, which leads us to a lower range of about 2% growth for the end of this year. So you can see that, this is kind of a wide spectrum of our assumptions here, but we do think that these are some of the fair projections that we see for China's economy going ahead. 2%, although it might not be as spectacular as what we saw in previous years, but growth is still growth. No doubt the whole world has kind of taken a hit this first quarter or so, or even towards the end of the year because of the virus. But that being said, it's something that we kind of have to accept, try not to fight it too much, but also kind of accept that this is something that has happened and you can't change what has happened, but rather accept and think about how to actually position yourselves going forward, right? So with these assumptions in place, we actually do see that China is going to recover and is going to form part of our core allocations going forward. So why are we so confident about this? Let me just bring you to this slide as you see here, the epidemic development phases in most of the major territories. So I like to think of this curve as a bit like a train ride, right? So imagine this curve represents a train called COVID-19, right? So whoever, you think about it logically, whoever gets on the train first will assumingly get out of the train first as well, right? So if you remember things that were happening in the last 3 months or so, China was the first one to get affected. That's why right now, if you look at this chart, as of April, I think they are right now at the late stage of the epidemic phase, right? And then if you remember 2 months, 3 months ago, when we were still happily, going on with our lives, we were reading some of the news that Italy has starting to have cases, South Korea, Spain, and Iran, and all those places, right? When we're still happily walking around town, right? So you see that those are slightly behind, and then USA is also starting to show some signs of easing of the virus, especially in the New York City states where those are more of the denser areas. We have states like Georgia starting to slowly open up as well. So those are some of the key indicators that these are starting to follow very closely behind China. And then of course you have some of your LATAM followers like Russia, Brazil, Turkey, some of the emerging markets as you see there. And I guess Singapore would likely fall in the early control stage, somewhere around where UAE is. I mean, of course, we do understand that our circuit breaker measures just got extended, but instead of taking a negative light to it, try to stay faithful and positive that, things are starting to look towards the better. Always remain calm and don't panic whenever our Prime Minister says that he's trying to address the nation at 5 p.m. or so, right? So I guess this is just to give you some outset of the context of where the world is in spite of this virus, right? But going back to China, we see that in most of the provinces, the work resumption rate is for most provinces is already close to full 100% for most of the provinces. So we see that this is actually quite a clear indication that China is already starting to emerge from its lockdown when it first started 2 months, 3 months ago. All right. And then another clear indicator here, as you see, it's the daily average coal consumption, right? So coal consumption is more of like an indicator of how busy the factories are, right? So of course, with higher coal consumption, it kind of gives you an indication that people are starting to go back to work, people are consuming more energy to get things done, right? And then seen here on the right, you see the congestion delay index, the congestion delay, which I think is just an indication of how things are looking like on the roads. So you see that in most of the major cities like Shanghai, Beijing, Guangzhou, and Shenzhen, right? Most of the congestion delay index is approaching a straight up trend from the beginning of the year. So I think this also shows that people are starting to get out of their houses a little bit more. At least, even if it's not to work, at least they are out and about, compared to what we are right now, which is in the lockdown phase, right? So I hope this is going to be the trend for Singapore's case soon, but of course we'll see what it's going to be like in the future. Okay, so this is kind of also going to form part of our case for why we think China is going to recover. So we kind of drew the trend of the retail sale of consumer goods trend back towards the SARS period, where we saw quite a big dip in the retail sale consumption of goods. So from that, I mean, with lockdowns in place, with a lot of measures in place, there's no wonder that consumption has kind of taken a hit, right? Even today. So, but we see that over the course of history, after things started to stabilize, consumption, the consumer will return. I mean, I believe you've also read articles like the MS store when it first opened, it racked in like what $3.8 million worth of sales in its first day. So I think that kind of spells quite a lot of big story for the Chinese consumer. I mean, if you ask yourself personally, right, even if we are in this lockdown situation in Singapore, I believe you've been telling yourself, oh, I can't wait to go back to, buying my stuff, or I can't wait to go shopping again, or I can't wait to do everything. So I guess it's a very human nature to, it's a very human, it's innate in us to want to consume things. So I guess after a steep lockdown for about 2 months, the consumer is bound to return. So this also forms the same case for China, and therefore it kind of builds up our case for why we think China will rebound for the rest of the year going ahead. All right. So to give you a bit of context, this is the China ACSI 300 index projection. So of course we project that based on its earnings, and we do see based on our own fair PE valuations, we project about an upside of 48% by the end of 2021. So these estimates may or may not change around going forward, but of course this is what we are seeing as of now, as of April 2020. All right, so this is just to give you some context of what we are thinking the earnings and the index projection is going to be like for China. So you might ask how you might want to get invested to get exposed into the Chinese shares, right? So for fund recommendations wise, our latest pick would be the UBS equity fund, which covers not only just China but also the Greater China region. So we see a lot of shares in the sense of, you know, covering Hong Kong, Taiwan, as well, the regional markets, right? So there may not be a lot of funds available out there to get you exposed in these kinds of funds, but based on our team's coverage, this is the latest pick as of now. So it started in April 2010 with a reasonable fund size of about 1.3 billion. And we see that we like this fund because, as you can see, it has quite a strong track record, total returns performance. If you were to draw your attention to the left-hand side chart, the fund in question is actually highlighted in red, and we paired it against some of its competitors, right? And the gray line is actually the MSCI China Index. So quite a good track record proven since April 2006 all the way until now. And it actually averaged about 10.3% in SGD terms all the way through to March 2020, right? So you see, even on the 3-year rolling returns basis, right, the fund has actually managed to stay fairly positive all the way, ranging anywhere from 0% all the way to about, you know, in the range of 18-20%. So I think the results kind of speaks for itself. And just to give you a little bit more context, we see that this fund actually tries to leverage on the industries that would benefit from China's structural growth. So what do we mean by structural growth? In the sense that China is actually going through an intrinsic and a very inherent change in its economy, where it's changing from an investment-driven to a services-led economy, right? We see a lot of internet companies starting to bump up in the Chinese space. So if you look at some of the top 10 holdings, you'll see your companies like Alibaba, Tencent, right? And of course, we also have your insurers like Ping An. And of course, who can forget about the Taiwan Semiconductor company, which is the largest semiconductor producer in the world, right? So all these major companies are actually captured by this one Greater China Fund, and I think we believe that this is a very good instrument to get you invested in the Greater China space. All right. So this is, once again, this is the fund that we recommend for the Greater China region. If you have any questions on how to get invested in it, you can feel free to approach your advisors. All right. So this is for the regional context. So we're going to move on to our second idea of the month, which is to invest in the world's fastest growing internet companies with this one ETF. So if you look at this picture that I've drawn up here, it kind of looks like everyone's desk right now because we're all working from home, right? But I think the bigger picture is with all of us working from home and a bigger trend from the macro context, what are the kind of companies that would stand to benefit from this trend? So digital internet companies are those that we see right over here. So you have companies in the e-commerce space, the e-services space, digital advertising, fintech, and of course, cloud services. So within, interestingly, according to our research team, right, all these companies actually make up about 9.5 trillion US dollars altogether. And actually that makes up about 10% of the entire world's GDP, right? Many of us may not have actually known that. So specifically, according to our team, if you look at the e-commerce space, you see that a lot of internet penetration rates are, although places in the West like America and Europe, they are already quite high, but a lot of us towards the East, like Asia, Australia, or even the Middle East, we are not even, or rather just crossing the halfway point. So we see that the internet penetration rate still has quite a lot of room to grow, and therefore we're going to bank on this digital economy space, which will ride on this trend as more and more people get hooked onto the internet usage, right? So interestingly, according to our team, the global e-commerce space, right, is going to become a $6.5 trillion economy by 2023. So if you pair that against from today onwards, right, that's going to make up about 16% annual growth rate from now all the way to 2023. That's a good 3 years, right? And what's more, China is actually currently holding on to the largest players in this field. So you see all your companies like Alibaba and JD.com, while in second place, of course, we have, who can ever forget, the biggest Western player, Amazon, who is dominating the tech industry over towards the West. But this is only one part of the entire space. Of course, we also have the digital advertising space where businesses are actually gunning on the trend that as more and more consumers are spending more time on the internet, right, with all your social media apps like Facebook, Instagram, and so on and so forth. a lot of companies are actually banking on this trend because they will want to spend more money on their advertisements over there, right? So with expenditure in this field slated to increase, right, compared to the traditional media like your newspapers or magazines, we see that the digital advertising space is also going to increase or rather grow by 12% each year from 2019 all the way to 2023. So that's actually making up about 60% of the global advertising market in itself. All right. So seen over here, I think you see these are some of the major players. You see that most of the FANG stocks like your Google's, Facebook's, Amazon is over there as well. Right now, I think Google holds the largest market share for the global digital advertising space. But of course, you have all your Asian players starting to catch up sooner or later. Sorry, I think there's a Ferrari outside my house. Okay. All right. So, but with so much data, we also see here that a lot of things need to be protected, right? Which is why there's also another business space in the cloud computing and cybersecurity market. So you see over here, all the companies like Amazon Web Services, Microsoft Azure, all these are the big players in the global cloud computing industry. And yeah, this is just for your reference that, you know, a lot of these companies are actually gunning to be in this space because of the wide importance of actually protecting your data as well. All right, so over here you see that in the cybersecurity space specifically, right, it's actually quite peculiar because there's no like clear market leader. So without a clear market leader, we only see large vendors like Cisco, Fortinet, which we are also using for our own VPN networks, right? Which are all, you know, kind of more or less equally or you know, I don't know, there's no clear market leader in this space as of now. So it's quite equally spaced, I would say, maybe a Cisco about 16%, Fortinet about 11%, and so on and so forth, right? But of course, we start to see more and more upstarts like the Zscaler, Okta, all these companies are starting to come into play as well. So how would you get invested in all these companies ranging from cloud computing to cybersecurity to digital advertising, right? With all these hot potatoes coming about, there's actually one wholesome ETF that helps to capture all these companies, which is the All Shares Global Internet Giants ETF. So just to give you some context, we actually recently onboarded this ETF in our own discretionary portfolio managed solutions. So it's because we believe so strongly in this internet trend. That's why we're also including this in our own in-house discretionary managed portfolio management service, right? It started somewhere, let me see. The fund size is about 63 million. I don't have the inception date. I think it's quite recent. I think only about a couple of years and a half back. So the ticker is OGIG, listed on the NYSE. All right, so these are some of the top holdings, which I've already mentioned just now. So no surprise, your common culprits would be the likes of your Amazons, your Alibabas, and all the way to even include things like Netflix. All right, so it's very interesting to see that if you can't get your hands on single stocks like all these companies, these ETF actually provides a very passive approach to gaining the exposure to the performance of all these companies. So on a valuation standpoint, for those of you who are a little bit more technical, if you look at the PE ratio alone, you might see that, you know, relative to other traditional stock in technology or even broad market indexes, it might seem like a very expensive choice. But when we take into account the growth prospects, you know, the projected earnings growth of these internet giants per se, if you look at the third column on the right-hand side, the PEG ratio, it actually stands for price earnings to growth ratio, meaning to say that it accounts for the growth prospects. We see that this internet giants is more than you know, fairly valued in that sense. So once again, remember that price is always what you pay, but value is what you get, right? You wouldn't want to pay too high a price for something that you're not going to get too much of a value on. But you see this PEG ratio actually takes into account the longer term earnings growth. So you see that on the fourth column, on the 3-year earnings growth column, you see that the internet giants ETF is actually having the most, even outperforming that of the broad market index like the S&P 500. All right, so this is just a little nugget of information for those of you who are concerned about valuations at this point. All right, so that wraps up our second idea of the month, which is the internet giants idea. Moving on to our third idea, which is more of those, more suitable for those of you who are preferring a more passive income approach, we like to present to you a bond idea for this month. Right. So for those of you who like some passive income and getting paid to wait for all this market volatility to, to pass through, right? We present to you the Thompson Medical Group bond, right? It got issued in July 2019. So the coupon is 4.8% and it's currently yielding, as I last checked, about 4.66%. Right, yield to maturity. So it's slated to mature on July 2022. So when it was issued, it was effectively a 3-year bond. If you buy it today, it would be about maybe 2.5 years, 2.25 years, 2.25 years to go. All right. So why do we like this bond? I think just to summarize all these wordy texts, if you just pay attention to the headers, first of all, these are the 3 most important things that you need to remember about this bond, right? So we like this group is because I think Thompson Medical Group is needs no introduction, right? It is the major healthcare operator owned by the billionaire Peter Lim, right? So majority owned by the billionaire Peter Lim. Right, so there is a healthy liquidity position. Its cash position is more than enough to cover its short-term current borrowings, and of course, there's also a lot of debt headroom that it needs to, if it needs to ever expand. But I don't think we don't think that there is a need for it to raise any of too much debt at this point. So in terms of the macro perspective, we see that medical tourism was likely to grow in this region, especially in Singapore, where we see a lot of, where we face an aging population phenomenon, right? So with more aging population phenomenon in Singapore or even the region, a lot of people want to be, those well-heeled, they will prefer to be, housed in private healthcare facilities such as those that are operated by the group. So that is also going to be beneficial for this group in the longer term. So on a valuation standpoint, we actually think that bondholders are sufficiently compensated. I think 4.67% is pretty reasonable and actually quite decent in such a low yielding environment such as that we see today, right? So this is one of the popular bonds, and also we are actually very confident about this liquidity position. That's why we are calling for this, right? So with that, I think you can approach your advisors if you are interested in getting your hands on this, right? Right. So this is our bond idea, and now we are going to wrap it up with our last idea of the month, right? This is actually Microsoft, right? I put MSFT here as it stands for the ticker, as it shows on the stock exchange. But I think no one needs an introduction to Microsoft, right? This is a stunning blue chip that offers great value at this point. So I'm sure most of you know what Microsoft is. You're probably already using it right now to even operate your computer, right? But let's take a deeper look at how this tech giant is actually structured and why we like it for the long run. All right. So a lot of you may not know, aside from those that are in the business, Microsoft is actually more than just your software operator, right? It actually has 3 revenue lines, which are more or less equally distributed in terms of its own revenue breakdown. So you see here that aside from its personal computing space, they also have businesses in the productivity and business processes and the intelligent cloud space as well. Remember, we talked about the cloud space just now when we talked about the internet giants ETF. So this is exactly what it is. So Microsoft develops, manufactures, licenses, sells all these various softwares and hardware products, right? But it's also best known for Windows OS, which is installed on billions of all these devices in the world. As one of the largest technology companies in the world, it has these 3 operating segments. So interesting fact. But I guess what's the more interesting point here is that seen over here over the past 5 years or so, right? From the first quarter of 2016, we see that year-on-year revenue growth, if we split it up by the segment, right, the one that has actually been actively leading the revenue growth for Microsoft is actually the blue line, which is in the intelligent cloud space. So Microsoft was able to deliver a revenue growth of about 8% year-on-year for the last 10 years, all right, which is impressive considering the company has actually been around for nearly half a decade already. So the rise of the intelligent cloud space was actually responsible for this 8%, very stunning 8% year-on-year revenue growth seen over here. But as of the second quarter, the company has actually 134 billion in its cash balance. So, we talk about all these companies being sold off unfairly in this crisis, right? But the reason why we like stocks like Microsoft is because of its very strong, a robust balance sheet. 134 billion in cash and equivalents, which far exceeds its total debt of about 87 billion. So this is actually putting the company in a very strong net cash position, right? It also has a current ratio of about 2.8, so a strong positive current ratio of 2.8, meaning that it's more than capable of actually meeting its short-term debt needs in that sense, right? So we all talk about saving up for a rainy day. I think Microsoft actually does it quite well in this sense as well. So on the credit rating wise, most of its rating agencies are still rating it AAA. So the rating agencies are also saying that it has the ability to obtain more funding at this point, even if it needs to at lower costs, right? So we've already pitched this against some of its competitors. So I've put Microsoft, Amazon, Apple, and IBM in this space. We see that Microsoft actually has the highest current ratio, right? But at the same time, it has one of the strongest net debt to equity positions. Okay, so on a valuation standpoint, our team has actually priced in about 198 target price based on our own fair PE multiple valuations. So this was actually written about maybe 2 to 3 weeks ago, so the prices might have changed already. But based on the price back then, we saw about 27% upside if you had bought about 3 weeks ago. I think today is about maybe a bit higher. I can't remember the price yet, but this represents still quite a fair bit of upsides to go from today if you buy in today. All right, so I think that wraps up what I have to say for the ideas of the month and how you can actually position yourself going forward. Angela, can you share the other screen? I'm going to stop sharing my screen for a while. All right, so do we have any questions at this point? Please feel free to type in your questions in the Q&A portion in the Zoom application. You can unmute yourself if you want to speak to me directly as well. Okay, maybe there are not much questions at this point, but if you do have any questions relating to the ideas that I've just pitched, the 4 ideas that I just pitched today, all right, please feel free to speak to your iGM advisors if you already have acquainted with them. All right, if not, you can always contact us at the following email or contact numbers. Now, I see a couple of questions here. Tom Cruise is asking me if this is a weekly or monthly webinar. This is slated to be a weekly webinar, so stay tuned for more to come forward in the future as we cover more and more topics. Now, next question, Wilfred asks, do I have any views on oil? Okay, this has been quite a hot potato in recent weeks, especially last week when we saw the price of the oil futures for WTI dipping towards negative territory of negative $37 and before rising up again. So I don't exactly, when you ask me, do I have any views on oil, you probably want to be a bit more specific on that. But if you're asking on whether I think it's a good time to buy oil as a commodity now, I can't give you an answer because for compliance reasons, also because we don't, as a company, we don't cover oil as a commodity, but I can shed some light on why the oil price actually went into negative territory. So basically what actually happened was the May contracts for the WTI futures, all right, they were slated to expire, I think, last Tuesday. So, there was there's been a lot of talk about shortage of demand and shortage of storage spaces as well, right? So with that, we saw that prices were being pushed downwards. And then even with the deal recently impacted, a lot of investors thought that the cut in production wasn't enough to keep oil prices going up. right? And then at the same time, there was this talk about the USO ETF, right, which a lot of investors were actually invested in. But what they didn't probably know was that the USO ETF had about 25% of its futures contracts invested in the May contract, the May WTI contract, which was about to expire last Tuesday. So because of that, everyone had to sell off at the same time. And I think that was what continuously pushed the oil price back towards negative territory. I guess what you can feast your eyes on right now is the pricing of the June contracts and maybe July contracts. We are still in a contango situation, which means we are experiencing a negative rolling yield if you were to just buy and hold a front month futures contracts, right? But then whether we think that there's going to be an upside for oil, I can't give you that answer because our research team doesn't cover it, right? But ultimately, it also depends on your own risk tolerance and your own risk profile and whether you can actually see that there is an upside for oil. If you want more on actually how you can get exposed into the oil as a commodity, you can speak to your advisors. We just had an update on it a couple of days ago. So if you have an advisor, please speak to him or her about this. Now, what's my view? Next question on what's my view on China high yield bonds, right? I think I can speak more broadly for the Asian high yield space. I think we actually covered this a couple of weeks ago or even last week's session. So on the Asian high yield space, we have no doubt seen an expansion in spreads, right, compared to just 3 months ago. So what we see is that when we juxtapose the average default rate, which is about maybe 2 to 3%, right? When we juxtapose a 3 times historical average default rate against what the historical spreads are actually showing us, we feel that the market has actually largely mispriced the potential default risk in the Asian high yield space. So what it means is to say that the spreads has actually widened more than what a rational investor would expect it to widen to, right? So historically, we have never seen yields expand to such a level, even back in the 2008-2009 financial crisis period, which is why we don't think that it is a very material expectation that there will be a real 3 times, 4 times, 5 times, Asian high yield bond default rates in the entire region. So with that, we see that with the elevated spread levels, we think that there will be a potential compression in spreads, and therefore this is actually quite a good, a good investment opportunity for you as well. If you want to get invested in it, you can actually consider some of the Asian high yield bond funds, right? You can speak to your advisors on that, on which ones they would want to put you in as of now. Okay, but that's my general view on the China high yield bond market. So the next question is, where do I think gold is going? Between gold and silver, which do I recommend? So once again, in the commodity space, unfortunately, our team doesn't cover it. So I can't give you an upside potential specifically based on the intrinsic price of let's say, gold, because I don't think that our team actually covers, we don't have an intrinsic price for gold in that sense. But what I can say for gold or silver or any of this purported safe haven assets, right, is that yes, there always is a place for these things in your portfolio, be it an exposure to the direct gold price. So if you want to do it via an ETF, there are some ETFs available for you to do so. Or if you want to get invested into gold-related companies like those miners, right, that's also another opportunity to do so. But whether there is a place for it in your portfolio, you also have to see what's inside your portfolio, right? If you already have traditional assets like equities and fixed income, then maybe there is a place for adding gold inside to lower your overall portfolio volatility. Because historically, we've seen that the price of gold has been largely uncorrelated to, let's say, the prices of equities or bonds or whatsoever, right? So you have to take a look at your portfolio holistically to see where gold is likely to fit. Right. If you want to have an allocation to it, I would maybe put about nominal 10% to, maximum 15% kind of allocation, just to provide a hedge against excessive volatility or the risk of your portfolio or your assets of the portfolio all moving into one direction directly. All right. So that is where I think gold is going to provide a benefit to your portfolio, in the sense that it will provide a hedge against excessive volatility. Okay. So that's the next question. What is your recommended method of investing into Microsoft stocks? So there are a couple of ways to do it. So I believe I've already shared some methods today. I've touched on the Internet Giants ETF. So that one covers not just companies like Microsoft, but also the wider digital economy space. So if you want to have a broader coverage around all these stocks, you can consider that OGIG ETF. But if you want to have the direct, stock exposure into Microsoft, then of course you can feel free to go ahead and buy the Microsoft stock directly. There are some unit trusts that invest into the technology sector as well, no doubt. Okay, but what we are pitching today is specifically on the digital economy space. So we see that most of the tech funds, tech unit trusts, they actually have a much wider coverage. So it's not so much concentrated on the digital economy. It actually includes things like semiconductors, IT development, and so on and so forth. So you can actually buy not just the unit trust, but if you want to complement it with this ETF or the Microsoft stock directly, that's actually more feasible. So think of the ETF or the unit trust like a set menu, right? If you don't exactly know what you want to eat in a set dinner, you can always buy the ETF or fund. But if you know you like specifically that one dish, then of course you can go and opt for the a la carte option and purchase the stock directly. Okay, so I hope that gives you some of the insights on how we think about methods of investing into particular stocks. Okay, so why is silver price lagging behind gold? So once again, this is actually outside of our scope. We don't have a intrinsic price on precious metals, but silver and gold, if you want to think of it from a fundamental perspective, right? We see that gold has always been the go-to for the safe haven assets. You don't always see silver as being the headline maker in that sense whenever there's a crisis in happening in the markets, right? So perhaps without this kind of liquidity in the market, perhaps that's why I think silver could largely lag behind gold. But if you think about it more from a historical perspective, gold has always been the go-to for, once again, the go-to for hedging your portfolio against adverse market movements, deleveraging your portfolio or lowering your overall volatility. So I think maybe that's why you see a lag in the pricing. But I can't, of course, put a finger to it to say maybe investors are not looking at silver as much, or investors are just putting institutional investors, for example, or maybe they are just putting more money into gold ETFs, for example. All right. Now, Tracy Lee is asking, is there only one China regional fund? Once again, no, but this is one of our team's picks for the month, because we think that I think it's timely to look at one fund that's also covering regional China, but also one with good performance. So no doubt we actually showed some of the peers over there when I showed you the performance just now, but if you want further options, you can always speak to your advisors. All right, I believe they'll be very more than well equipped to help you to make your choice on which China regional fund you should pick. All right, what about Singapore markets? In general, because of the way the question is phrased in just 4 words, right? I don't exactly know what you want me to talk about specifically, but right now, I guess what we're all focused on is our economic data, right? So we no doubt just had an announcement of the budget a couple of weeks back. So we haven't had an update on that yet. But if you want to look at Singapore markets, you can actually look at the dividend-focused companies. So a lot of these companies are actually captured in most of your Singapore funds or unit trusts available out there, right? Where they capture companies that have a history of paying out stable and growing dividends, right? So I think Singapore markets would do well in that aspect for now, right? Of course, we'll be taking a hit from our virus-related issues for the first quarter or even in second quarter. We'll see how the extended circuit breaker goes, right? But let's all hope for a clear, clean-cut ending of this thing very soon. All right, so that's all I can say about Singapore markets for now. Now, the next question in terms of equity, what industries may benefit from the low oil price? Transport of oil tankers come to mind. So in terms of equity, if you think about it, right, the low oil price essentially acts as a consumption tax cut for the heavy oil importers such as China. So I think this actually links very nicely to our idea of the month, which is China, right? So China actually being the largest oil importer of the world, right? And then you juxtapose that with a low oil price, you actually see that this low oil price actually acts as a, like effectively as a consumption tax cut for them. So in the longer run, when they start to recover, you know, no doubt oil also places a lot of issues on deflation, right? But with cheaper oil prices, this could actually be a benefit for these countries as well. So in terms of equity, I can advise based on the kind of regions that you can look at, which is of course China, right? And then you see which are the other economies that are looking to benefit from this, and you will get invested in that. Okay, transport of all tankers wise, I don't think we have a view on that, so I can't advise specifically. But if you want, I think our team has also coverage on the MLPX ETF, which looks at the midstream oil sector. So if you want, you can speak to your advisors on that. We actually did make a call on the midstream energy sector a year back or so. All right. Now, the next question, is there a debt crisis coming? What is the impact we are expecting from QE from the US? Now, is there a debt crisis coming? Based on what our team is looking at, I don't think there is. But what we can say from the QE is that, you know, no doubt all over the world, we see that, you know, central banks, not just the Federal Reserve, but even the ECB, you know, even our own Singapore Central Bank, they've been pumping liquidity into the market to try to keep things afloat. I guess what you want to hear is some assurance that we won't be seeing a 2008, 2009 kind of situation happening once again, right? So there are some situations or black swan events that could lead to this happening. So I'm thinking in a sense of a very pessimistic way. So let's say there is not enough liquidity in the market, even after all the central banks are doing all they can. Let's say there's just not enough liquidity. Let's just say that the COVID-19 virus evolves to some other vicious virus that forces the entire world into another period of lockdown. Then maybe we see that, you know, airline companies, maybe they are starting to default on some of their bonds, right? They are starting to default, not just the airline companies, but maybe all the other companies that have actually made loans with the banks, right? So if this is really like a meteorite kind of situation, if let's say you really imagine that kind of apocalyptic scenario, then maybe we could see something like that happening. But right now, you know, if we think about it rationally, I don't think this is a likely scenario. So from a QE perspective, you know, it's always a good thing that it's always a good thing that we see that the Fed and the governments are doing all that they can to keep companies afloat. So I think what we would like to keep our eyes on right now would be largely maybe the Q2, Q3 earnings. So no doubt Q2 may be pretty much hit because a lot of countries were already into lockdown. But of course, if you take a longer term perspective, which is what we all recommend our clients to do, then your eyes should be headed towards what's happening after this whole virus situation blows over. All right. Now, next question, possible recession in the next 2 quarters. Right, so just to simplify things, our team has actually made a recessionary call even in the first quarter. So I think even 2 months back when this whole thing started to blow over, we already started to make a call that there might be potentially a recession in the first and the second quarter. But by the way things are going, we actually see that there might be a potential good pickup from the third quarter and the fourth quarter onwards. So based on fundamentals, we don't think that recession is likely to occur past 2020. But of course, we'll continue to monitor the situation and our advisors will update you accordingly. Any thoughts on getting China H shares instead of A shares? All right, so just to set the outset, China H shares and China A shares differ on where they're listed. So China H shares are those shares of companies that are listed in Hong Kong exchanges, but the A shares are those listed on the China mainland exchanges. So we do have coverage on both A shares and H shares. It's just that the chart that I showed you just now was just one of the two, which is the A shares one, right? So for A shares and H shares, we are both bullish on it. H shares are largely more beaten down, even stemming from last year because of the riots in Hong Kong, right? which is why we actually priced in about a 60% upside for China H shares last year and at the end of 2021. Right, so we are still holding a very bullish view on both China A and H shares. But of course, if you want to get ahead in not just one of the other, you can actually explore, an all-encompassing Greater China Fund, like the one that I actually pitched just now. Okay. So Hing is asking, according to I saw on YouTube analysis, due to the COVID-19, China economy is negative BE in the first quarter. I don't know what that is. And due to many MNC that cancel ordering China factories, a lot will be closed and shut down. So the China fund, why you still see as a good one to buy? Okay. So perhaps I can clarify that. So yes, we do see that China has, once again, I reinforce that China has not been spared. In fact, it was the first one to see its economy take a hit in the first and second quarter, right? But having said that, when we invest for the long term, and we don't see this crisis panning out for the next 2 to 3 years or 4 years or 5 years, which is why when we base our calls on extended earnings towards the future, we think that China is still quite a good buy, right? And if you see the track record of that fund, right, I think it has managed to weather quite a number of crises in the last decade or so. So even if you suffer maybe a couple of drawdowns in 1 or 2 years, if you invest it for the longer term, you see that the recoveries will more than be able to offset the kind of losses that you experience in the short term. So I think it's also a good time to reassess your own risk tolerance. A lot of clients are really start to ask themselves whether they can really stomach the kind of volatility. It's all well and good to say that, yes, I can take the risk. I'm a long-term investor, when the outlook is positive and when things are going on the smooth. But it's actually during such times when you really test yourself and ask whether you really do have the stomach to go forward with that kind of volatility. If the answer is not a clear yes, then I suggest you realign your interests, or rather realign your investment goals with your advisor, and we can actually readjust your portfolios accordingly. All right. And the next question is from Saurabh. So any investment suggestions for Singapore market, any sector favorites? We don't exactly have a particular sector favorite, but I guess we can target like I mentioned just now, the dividend focused companies. So funds that offer you this kind of exposure would be the Nikko AM Singapore Dividend Equity Fund, right? We actually also do have a stock managed account, which is managed by Nikko Asset Management, which allows you to invest in not just Singapore equities, direct Singapore equities, but also those equities that are listed on Hong Kong exchanges and US exchanges as well. So if you do want some direct stock exposures for not just the Singapore market, because Singapore market clearly is not just it's not going to be enough to weather you through this crisis, or even for a normal portfolio, because you're just investing into one home market, right? You need to diversify, and you need to diversify globally. Right, so you can consider our stock managed account with your advisor if you want direct stock exposures globally, or you can also explore some of the funds available on our platform. All right, the next question asks, with the increase in unemployment rate and alarming number of COVID-19 cases in the US, do you foresee a recession coming, and how will the tech sector get affected? So I believe I've already answered the recession question, right? But for the second part on whether how the tech sector will get affected, I guess I can address that right now. So for the purposes of the tech sector, we do see that most of the stocks have actually been unfairly beaten down. All right, on a PE basis, they're actually looking a bit more attractive right now, right? And then it ties in very nicely with the sector, with the digital economy sector that I just pitched today, as well as a direct stock idea, which is the Microsoft. So if you think about it, you are not going to stop using your computers, you're not going to stop using your phones going forward in the next year or so, right? It's why we're having a very strong call on sectors such as semiconductors, even the technology space, because we see that even when other companies are taking a hit, companies like Amazon and Netflix are actually being more energized in this period. So from there, you can actually see how the tech sector is actually going to benefit even more powerfully from this crisis in the short term. All right, and of course, in the long term, we also advise our clients to stick with their guns, play on earnings, forward earnings. What are the fees charged by IGM advisors? This one you can link directly to your own iGM advisors. So I won't be in the position to advise on the fees charged. So once again, you can always contact us if you don't already know any iGM advisor. You can contact us at this email address shown on the screen or call in the number. Or if you already have some iGM advisor that you are acquainted to, you can feel free to approach them directly. Okay. Now, what do you think about leveraged ETFs? Good to go into. Leveraged ETFs, okay, depending on what you're talking about. I mean, generally, when we talk about investing ideas, we don't advocate the use of leverage, at least not on our platform. So the only form of leverage per se we have available on our platform would be the availability of a portfolio financing capacity, right? So if you do have, let's say, a sum of money that you are invested in, let's say, unit trusts, right? You can actually use that block of unit trust to pledge it as your assets, and then you can actually take a loan from a bank that we are in business with, which is CIMB. So this is just to let you know our form of leverage. But going back to the topic on leveraged ETFs, we don't exactly have a view on the use of leverage in the use of leveraged ETFs. I mean, if you are of the view, if let's say that you are of a very convicted view that you want to use leveraged ETFs to enhance your returns for a particular index per se, then of course go ahead. But we can only advise based on the more vanilla products, because that's where we form our own earnings expectations on. Okay. Now the next question is there no consequence for pumping liquidity? What about inflation? Okay, I guess I can target the issue on inflation first. So if you look at the way inflation has been, we are actually very low inflationary environment, right? The reason why the Feds are actually pumping in liquidity is to try to drive inflation, right? Because with such a low inflationary environment, there's not enough spending going around, right? If you go back to 2008 and 2009, the reason why they did the same thing as they're doing today is to just put easy money, right? We see easy money flowing into the market, and then you see an expansion for the next 10 years. And that's where you see inflation maybe starting to rise up a little bit here and there, which is why they started to increase interest rates from the end of 2016 onwards. But right now, clearly, we're in a deflationary environment. Interest rates have been cut to near zero. You know, we don't see any potential near-term risks for inflation. We're in fact worried about the fact that there is no inflation to begin with. So I wouldn't see that a clear consequence for pumping liquidity when it comes to inflation in the near term. So why is inflation still flat with so much liquidity in the market? Linking to the previous question, right? Why is inflation still flat? It's because we are still in this crisis. You know, there's still not enough spending going on in the market, and I guess that leads on to why there's not much inflation. Hold on, let me see. Okay, I'm going to take, let me see, the next 3 questions or so. Okay, yeah, the last 3 questions. So for the UBS fund, would you recommend a good time lump sum investment or a DCA? Okay, I don't know what's a DCA, but I guess it's some form of dollar cost average, right, RSP, okay, dollar cost averaging. Okay, so for the UBS, would I recommend a good lump sum investment? I guess this depends on your own liquidity needs, right, Ryan? So if you have, let's say, a spare amount of cash to go into, let's say $100,000, perhaps you can consider putting 50,000 into the fund, and then from there you can actually the rest of the investment you can actually do it on a dollar cost averaging method. So you entry into the market, and then you start investing on dollar cost averaging to lower your average cost in this environment going forward. CA method, you try to catch a rhythm. Okay. What are your thoughts about Square Inc. 10 years later? Right, I don't have a thought about this company because we don't cover this company, sorry, whoever asked this question. So I can't give you a thought about this specifically right now. Okay, this one, if you have any thoughts, please speak with you. Okay, Tom Holland is asking again, with the increasingly competitive streaming entertainment industry, where do you see Netflix relative to Disney? All right, interestingly enough, we actually did talk about this issue last year in one of our own research team meetings, right? We actually said that Netflix was potentially a sell because they were having so much competitors, right? So we see Disney, I think YouTube is also starting their own streaming business, and a lot of other companies are coming into the space. But I guess talking about the FANG stocks, you can't invest in a technology fund without touching Netflix, right? So we'll continue to monitor the earnings of Netflix, but of course, we are not saying that it is a complete sell right now. So for the purposes of some of your funds, I think Netflix still sits on a lot of its top 10 holdings, right? So I think Netflix is still one of the bellwether companies that you can't totally ignore, right? Until we see, let's say, a clear disruptor that is going to remove Netflix from the entire streaming business space, then of course we'll still want to keep an eye on the company. All right, and the last question here is, what is your take on the payment industry, and in particular Square Inc? Will companies like Square benefit from the companies? So sorry, once again, I don't have specific knowledge on this company. If you do have questions on this, please feel free to get in touch with your advisor. If you don't, then feel free to reach out to us via this email or contact number. Okay, so I guess I've answered all the questions as of now. I thank you for joining us, and we will be holding subsequent sessions going forward on various topics. All right, if you do have any questions, feel free to reach out to us or your own iGM advisors if you're already acquainted with any of them. And that's all for today. I wish you good health, stay home, stay safe. God bless you all. Thank you.